This course is Financial Management. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and an adjunct professor of accounting and financial management. For this course, we will use the excellent text Intermediate Financial Management by Brigham and Davis. And in this lecture, we will cover the second half of Chapter 6 on accounting for financial management. Continuing from where we left off in the first half of this chapter, we will look at how the firm uses its free cash flow. The first item on the list is after-tax interest payments. The reason this is after tax is because corporations are allowed to write off interest on their taxes. So to get this number, you take the interest that the firm paid and multiply it by 1 minus the corporate tax rate, which is assumed at 40%. So that would be the interest times 0.6, or 105,600. They can also use the free cash flow as a reduction or an increase in debt. In this case, they are adding more debt at $1,196,568. They are also paying dividends of $11,000. They are not repurchasing or issuing any new stock, but they are selling some of their short-term investments to finance their expansion. So that is a negative $28,600. Summing up, the interest payments are positive because that is money returned to the investors. The dividends are positive because that is money returned to stock investors, whereas the increase in debt is negative because that is more money taken from debt investors, and the sale of short-term investments is also negative because that is more money taken from investors. So overall, the free cash flow is negative $1,108,568. That is more money taken from investors to invest in the company. There are a lot of different measurements of how a company is performing. We will cover a few of those in this chapter and a lot more in the next chapter. One of them is the return on invested capital, or ROIC, which is defined as NOPAT, net operating profit after taxes, divided by operating capital, where again the operating capital is the net operating working capital, short-term operating capital, plus the net fixed assets. We calculated the operating capital earlier at $2,258,632. We calculated NOPAT, net operating profit after tax, at $10,464. So this is a very poor ROIC of 0.5%, much lower than in 2014 when it was 11%. So the firm's cost of capital was 10%, and we ask, did the growth add value? The answer so far is no, because you borrow at 10%, you invest at 0.5%, so you are losing 9.5% on your money. And they note here that high growth usually causes negative free cash flow. You're selling more stock, you're borrowing more money, you're investing to expand. But that's okay if ROIC is greater than WACC. For example, in 2008, Qualcomm had high growth, negative free cash flow, but a high ROIC. Another measurement of company performance is economic value added, or NOPAT minus WACC times capital. So NOPAT is again net operating profit after taxes. That will be in dollars. WACC is a percent or a fractional rate of return. Capital is in dollars what you have invested. So if you take what you've invested, capital, times your rate of return, WACC, you will get the dollar amount that it costs you to invest in the company. NOPAT gives you the dollar profit from investing in the company. If EVA is positive, then you have made a dollar amount positive EPA by investing in the company. If EVA is negative, then you have lost the dollar amount of EVA by investing in the company. In our example for 2015, NOPAT minus WACC times capital or EVA will be the 10,464 NOPAT minus the 10% WACC times the 2,257,632 operating working capital. This gives us a loss of $215,299 by investing in this company in 2015. In contrast, in 2014, you had a positive EVA of 11,600. Other data for the company, you can see that the stockholders have not responded positively to this expansion since the stock price has gone down from $8.50 a share in 2014 to $6 in 2015. The number of shares has stayed the same. The earnings per share, which is net income divided by the number of shares, was positive in 2014 at 88 cents, is negative in 2015 at negative 95 cents. The dividends per share has also been cut from 22 cents per share in 2014 to 11 cents per share in 2015. So right now the expansion is not serving the stockholders very well. Another measurement of company performance is market value added, or the market value of the firm minus the book value of the firm. The market value of the firm will be the number of shares outstanding times the stock price per share, plus what is commonly left off, the value of the debt. Whereas the book value is the total common equity plus the value of the debt. If the market value of the debt is close to the book value of the debt, then MVA can be reduced to market value of equity minus book value of equity. This was probably more true in 2014 and 15 than it is today. Right now, since interest rates have gone up drastically, the market value of debt has gone down drastically. And this has helped a lot of companies that are in debt and has hurt a lot of banks and bondholders. For example, that's why Silicon Valley Bank went bankrupt. But for the assumption of this lecture, we will assume that the market value of debt is same as the book value of debt. So 2015, market value added, assuming market value of debt equals book value of debt, is going to be, in 2015, the 100,000 shares times the $6 per share are 600,000, whereas the book value of equity in 2015 was only 557,632. So in 2015, the market value added is the 600,000 market value of equity minus the book value of equity, which gives you a market value added of 42,368, significantly down from the market value added in 2014 of 186,232. Now we will do a brief introduction to the tax code in the United States. I have an entire separate lecture on the history of taxes in the U.S., which is worth watching. Here we will just give a brief summary of both corporate and individual taxes. Donald Trump, in his first term, got the corporate tax rate in the U.S. reduced to a flat rate of 21%. Before that, the U.S. had some of the highest corporate tax rates in the world, which was inspiring a lot of companies to leave the United States. For example, Burger King left the U.S. and became a Canadian company. There are countries in the U.S. that still have significantly lower corporate taxes. For example, Ireland and Hungary have some of the lowest. So before the Trump tax cuts, the table we have here was the table for corporate taxes, which was a quite complex, pseudo-progressive tax system where corporations for the first 50,000 paid 15%, and then the next 25,000 paid 25% on their income. Then it went up for 34%, then 39%, and then it gets even more bizarre and goes down to 34, up to 35, down, up to 38, and down to 35. So this created a very bizarre system where actually, in many cases, big companies paid a lower tax rate than intermediate-sized companies. So this was simplified by the Trump tax code, and this is permanent. This would have to be changed by an act of Congress. It does not expire like many of the personal tax cuts that happened under the Trump administration. So this previously bizarre corporate taxation had progressive rates up to $18.3 million, below $18.3 million. The marginal rate is not equal to the average rate, but above the $18.3 million. The marginal rate and the average rate were set at 35%. There are advantages to being a corporation. For example, a corporation can deduct interest expenses, but not its dividend payments. With the exception of home mortgage interest deductions, the individual can generally not deduct interest expenses. I guess the other exception would be student loan interest expenses. Before the Reagan tax code changes, individuals could deduct a lot more interest expenses. Reagan cut tax brackets, but cut out expenses like the interest deduction. Bush, of course, brought back higher tax rates and did not put back these deductions. Corporations can also do a carryback of losses for up to 2 years and a carry forward of losses for up to 20 years. Individuals get some benefit from this, like if you lose money on a stock investment, you can write off $3,000 a year and carry that forward, but you can't write off the full loss in a year. Also, corporations have some more bizarre and complex features, like they can exclude 70% of dividend income if they own less than 20% of the company's stock, and it's even more complex than that. There are other exclusions depending on the ownership of the company's stock. And these numbers are regularly changed. The number of years losses can be carried back or forward is regularly changed by the tax code. So, for example, assume a corporation has $100,000 of taxable income from operations, $5,000 of interest income, and $10,000 of dividend income. Then what is its tax liability going to be? So we have operating income of $100,000. We add the $5,000 in interest income. So for a company, they add interest income and subtract interest expense before calculating taxes. But the dividend income is bizarre. The portion that is taxable is only 30% of the $10,000 or $3,000. So their taxable income is $108,000. So they add in 30% of dividend income, and then the dividend expense is taken out after taxes. So our company has a taxable income of $108,000. If we look back at the tax table, this puts them in the bracket between $100,000 and $335,000. The tax at the bottom of that bracket is $22,250, and that's in the 39% tax bracket. So the tax on the base is $22,250, and the tax on the amount over the base is the $108,000 minus the $100,000 at the base, are $8,000 times the bracket of 39%, which gives them a total tax of $25,370. Well, corporate taxes are not handled in this complex of a way anymore. Personal taxes still are, so it's worth learning how to deal with a progressive progressive tax code system. Personal taxes in the United States are extremely complex. Individuals currently face a progressive tax rates from 10% to 37%. This is changed regularly by the U.S. Congress. Marginal personal rates were up to 91% from Franklin Delano Roosevelt's era, partially responsible for the Great Depression, until John F. Kennedy started cutting them, and then Ronald Reagan cut them further down to a top marginal rate of 28%. Of course, George Bush and Bill Clinton brought them right back up. The current rate on long-term capital gains is capped at 15%. For some people, it is 0%, and capital gains are only taxed if you sell the asset. So, as repeated regularly, people like Warren Buffett and other people who make most of their money on capital gains pay a much lower tax rate than individuals who work for a living. Of course, if the U.S. tried to raise capital gains taxes, then people would move their money overseas, where many countries don't tax capital gains at all. Qualified dividends are taxed at the same rate as capital gains. Not all dividends are qualified. If they look more like an interest payment, then they are not qualified and they are taxed at the full marginal rate. Interest on municipal, state, and local government bonds is not subject to federal taxation. If we were to do a comparison between a private investor investing in If we were to do a comparison between an individual investor investing in corporate bonds versus government bonds, we could look at, for example, ExxonMobil bonds paying 10% versus California municipal bonds at 7%, and see what the after-tax return for this investor would be. For our example, the tax rate is 25%. Therefore, the after-tax interest income on the ExxonMobil bonds will be, well, if they invest $5,000, they get 10% of that, or $500, but the government seizes 25% of that in taxation, which would be $500 times 0.25, or $125. So the after-tax rate of return for the ExxonMobil investor is not 10%, but only 7.5% of the $5,000, or $375. If the investor invested in California bonds at 7%, they would pay no taxes, so they would get 7% of 5,000, or $350. In this example, our individual investor is better off in the corporate bonds than in the government bonds. We could ask at what interest rate the individual investor would be indifferent between corporate versus government bonds. To do this, we would set the after-tax muni yield at 7%, equal to the after-tax corporate yield, which is the corporate yield times 1 minus the tax rate. That would be 10% times 1 minus t. We can rearrange that equation, and 1 minus t is 0.7 or 70%, therefore t is 30%. So a wealthy, high-taxed investor is going to be better off in municipal bonds, whereas a poorer, lower-income investor is better off in private bonds. Since as a result of this relationship, governments pay lower interest on their debt than private corporations, this system is regularly abused by having governments create buildings and then renting them to private corporations. For example, in Chicago, I knew at one point the government built a lot of Walmart stores and leased them to Walmart, and this would give Walmart a lower interest rate and therefore a competitive advantage over its competition than if they had to go to the private market. Again, the implications of this are if you have a high income and a tax rate above 30%, you buy tax-exempt municipals. If you have a lower income, you buy corporate bonds. What is the current state in 2025 of tax brackets and the federal income tax rates? Well, this will be the system under Donald Trump's tax cuts, which may expire in 2025, although now that the Republicans have the House, the Senate, and the presidency, it is likely they will extend them. So the current deduction for single individuals is $15,000. Married filing jointly is $30,000, 2 times the single deduction, and head of household is $22,500. So if you have an income below this, you do not have to pay regular taxes. Of course, you still have to pay Social Security taxes. We currently have this bizarrely long, complex progressive tax code system where the taxable income up to, for a single filer, $11,925 is taxed at 10%, and then you go all the way up to a tax bracket of 37% for a single individual making more than $626,350, or a married couple, $751,600. Note, in the lower brackets, there is not a marriage tax penalty. You don't get taxed at a higher rate for being married, but at the higher brackets, there still is. As noted earlier, capital gains and qualified dividends in the U.S. are taxed at a lower rate for individuals than regular income. For example, unmarried individuals with a taxable income up to $48,350 will not pay any taxes on their qualified dividends or capital gains, and that is the same for a married couple at twice that dollar amount, or $96,700, and head of household with a taxable income up to $64,750 do not pay any taxes on their capital gains. With incomes between $48,350 and $533,400, individuals will pay a 15% rate. Above the $533,400, they will pay a 20% rate. For married couples between $96,700 and $600,050 will pay a 15% rate. Above that, they will pay a 20% rate. You can see here there is, again, a marriage tax penalty. For heads of households between $64,750 and up to $566,700, they pay a 15% rate. And above the $566,700, they pay a 20% rate. I thank you for watching this video.